Good morning, good afternoon, and for some of you, good evening. We're delighted to have you join us today for the live MOOC session for the Financing for Development. And this is entitled today, Unlocking Investment Opportunities. My name is Diane Damsky, and I will be your moderator today. I am an advisor to Joachim Levy, the World Bank Group CFO and Managing Director. I joined the World Bank last fall following more than 30 years in the private sector in finance. I'm very happy to be joined today by two very well-respected and well-known representatives from the private sector. We have Teresa Barger, the CEO and co-founder of Cartica Capital. This is a firm that specializes in emerging market investments. Teresa is often referred to as an activist investor, and she also knows the World Bank Group quite well, having spent 21 years at the IFC. Also joining us today is Dante Disparte, the CEO and founder of Risk Cooperative. This is a firm specializing in delivering risk solutions on a global basis. After each panelist has introduced themselves a bit more and provided some opening remarks, we will launch into the questions that we hear most commonly about the challenges and risks of investing in emerging markets. At the World Bank Group, we are very focused on increasing the partnership that we have with the private sector. Opening doors to private investment is a critical part of helping to meet our twin goals of eradicating extreme poverty and enhancing shared prosperity. And with that, Teresa, if you'd like to share more of your background with the audience.
Thank you, Diane. So I have, as Diane said, spent 21 years at International Finance Corporation investing in emerging markets companies. And at IFC, one has the opportunity to invest across many, many sectors as well as across all countries and regions, which is a very rich kind of experience to have. A lot of IFC's investments are, in fact, private in the equity side, part of private equity investments. Also, IFC does invest in companies that are listed. In the space that I worked in my last rotation was corporate governance. About 2/3 of the companies we dealt with were listed and 1/3 were not listed. At Cartica, a firm that I co-founded in 2008, we really focus only on listed companies, but I do have experience, and we're also only in the emerging markets, but I do have experience prior in frontier markets as well as in private equity. I'm a co-founder of the Emerging Markets Private Equity Association, MPIA, and I still remain as vice chairman there. So I have my finger in private equity kind of as a hobby, I would say.
Thank you, Teresa. Dante?
Yeah, well, thank you both. I'm delighted to be here as well, and thank you to the World Bank Group for including me in this important conversation. So prior to forming Risk Cooperative, which is a specialist provider of all things risk and insurance related on a global scope, I used to run a company in D.C. called Clements Worldwide, which insured 70% of the U.S. Foreign Service community, and we had clients in more than 180 countries, so a pretty global footprint. Today, in terms of mobilization of capital to private capital to emerging and developing markets, I'm also a member of a new initiative known as Bretton Woods II with New America. And the Bretton Woods II initiative is all about, again, getting private capital off the sidelines. There's $35 trillion of long-range assets under management that, frankly, are not being deployed. And we think these types of investors are too big to hide. And so part of what we try to do in that initiative is to create frameworks to better understand risk, better understand opacity in these markets, and how you could harness effectively a lot of these opportunities. So I spend a good portion of my day really trying to operationalize a lot of what we will discuss in today's session.
Great. Well, as you can tell, we have two incredibly qualified people for this discussion. So thank you again. I wanted to start by asking a general question about today's session topic. We hear a lot about investment risk in emerging economies. What is your view of the types of risks that investors should worry about? And just in general, what is the environment, the risk environment in emerging markets today? So Teresa, we'll start with you.
Okay. If I could take that in two parts. first of all, what we look for, and secondly, the general risk environment today. So we at Cardico start with country selection because there are 15 studies, and 16 if you include the unpublished IFC study, that show that the way that one makes profits above the benchmark in emerging markets is by choosing countries first, because country has more influence on your outcomes than sector or even company. So on the country level, the first thing that we're going to look at are the big factors affecting the country, and that will be the political environment, the macroeconomic environment, and the policy environment. And while doing that, one would then also look at currency, which has to do with the external vulnerabilities of the country. So we would, in looking at the macroeconomic, we would try to look for the current account deficit, for example. Is it financeable? How vulnerable are those sources of finance for the current account deficit? And so happy to go into in more detail in any of those environments. Then we look at the company level. And at the company level, they are going to face a number of kind of environmental risks. One will be policy risk, and that's we take very seriously whether they are a company that is dealing directly with the government, indirectly with the government, or simply is regulated or have policy concerns, even if they're not a deeply regulated industry like a utility. Even obviously consumer goods would have risks from normal things like food safety or consumer protections. So we look at the policy risks that they would run. We'll also look at any kind of risk to their supply chain. That would be to the reliability of their supply chain, as well as, of course, the costs involved in their supply chain. So that's a risk we would have to take a look at. There would be a risk on the customer side. How robust is their customer base? How vulnerable is their customer base to changes that might be happening in the country? And again, are their customers subject to any kind of policy, political risks that might impair their doing business for them? And then we'd look at the competitive environment. And are there any kind of issues in the environment that perhaps might favor one competitor over another, and particularly over this company. And then the third level we'd look at is the micro level of the company itself. And here, the most basic level, we look at whether they have a robust business model, whether they have a strategy that will further that business model, and that strategy would need to be created and presented by an excellent management team. And you would need a corporate governance environment that then holds management's feet to the fire for executing against that strategy. So excellent management will also be a key thing we'll be looking at.
And so when you make your investments, your investors, they go to Cardico Capital because they know that you have the wherewithal of just assessing all these different investments. Do they ask you questions at some of the shareholder meetings or investor meetings in particular about risk?
Yes, absolutely. So the investors are very concerned about risk and return. So what kind of return are we getting for the kind of risk we are taking? And this is, I think, where we're getting into a lot of intricate debates in the investment community about what is risk. Traditionally, limited partners, investors in funds like mine, looked at risks as the volatility. And that is the volatility of the stocks in a market. We work in volatile markets. We work in markets that are not very liquid, and there's not a lot of trading in each of these stocks. And so that's just sort of the air we breathe. That's what we live in. And so what we've been able to show is that our strategy, we're able to give higher returns with lower volatility. Whether volatility is really the correct Risk measurement, I think, is up for debate. And I would like to throw something out, and I'm sure Dante has a lot of views on this. And this is at the risk of derailing your second part of your question, the risk environment today. That we're really looking at risk today in two parts. One is uncertainty, and one is risk. So traditionally, risk is are opportunities you take where you can assign a probability to the outcomes of different scenarios. And so you have a Bayesian probability model, and you can apply that to a company, to a country, and really understand what is the percent probability of outcome A, B, or C. Uncertainty is an environment where you cannot use a probability model. And the interesting thing I think that we're facing today, and I'd be interested in Dante's view of that, is that in the emerging markets, traditionally, they were seen as more uncertain markets. The institutional quality of the governance structures, the political governance structures of the judiciary, of the peaceful transfer of power, of the regulatory environment was more uncertain in emerging markets. Therefore, companies traded in emerging markets had to trade at a premium to those in the developed markets. What we're seeing now is uncertainty coming into the developed markets. With Brexit, the U.S. elections, the French elections, et cetera, the big question is this differential in the risk premium that people require to invest in emerging markets versus the developed markets coming down? And are we seeing some of the reforms in some, but not all, emerging markets leading to less uncertainty in some of these good emerging markets that are reforming? And we can talk about some that are not, versus the developed markets.
That's a great point. Dante, from the risk perspective, based upon Teresa's comments.
Yeah, so, I mean, wonderful context, Teresa. Thank you for setting the stage so well as you just did. From my vantage point, I always try to take the lens of the institutional investor. And step one is to recognize that we have so much capital. We're flush with liquidity. And this notion of the flight to safety and keeping capital in safe markets, in my mind, smacks a little bit of a lack of imagination. That when you talk to many large asset holders, going south of the Mediterranean is a line too far for them. And so I think, step one for me is first to understand that there's no such thing in my mind as bad country risk. That country risk can be hedged fully, and you could price it fully. But that there are good investments and there are good industries in even the worst places on the planet. That's kind of one big intuition that I think it's important to share with folks. The other one is this notion that the whole world is starting to really resemble an emerging market, right? So the political risk expert Ian Bremmer says that an emerging market is a place where politics matters nearly as much as economics. And by that measure, given Brexit, given the U.S. elections, given, again, the tendency of fragmentation now across continental Europe, we all start to see that uncertainty is coming home to roost in the very safe places where we were hiding capital. And so the argument today is, how do we pre-invest in the very outcomes that we want to see? So large asset holders thrive on market stability. They thrive on predictable environments. And I think it behooves them to start investing in the very sources of stability that they need for their business models to work. No emerging market price swing will lose trillions of dollars. Yet you're seeing those types of big Six Sigma black swan type of events are occurring with higher probabilities in the United States, higher probabilities in continental Europe and in all of the advanced economies. And so I think we live in a world, as I wrote about in my recent book, where you see a convergence of both man-made and natural risk. And loved your point about the fact that risk you can measure, but uncertainty you cannot. And what we're introducing right now, especially when you think about the need for a long investment horizon, is we're introducing a lot of factors that are difficult to measure. Natural risk has no agency. Earthquakes, tornadoes don't necessarily plot where they're going to occur. But man-made risk does. And man-made risk is affecting us at every turn, whether it's things like cyber risk, whether it's socio-political cohesion, whether it's political risk, and many others.
Famine right now.
Yeah, indeed. And many of these things are coming home to roost. And we're realizing that in so many ways the post-war apparatus is starting to crack, right? The notion of the return of economic nationalism, that I'm going to protect my own country and my own people above your interest, that we live in an era where most people are retreating from global engagement. And in that environment, it's going to be very difficult to achieve the Sustainable Development Goals and move from the billions to trillions model, where I think the principal message has to be leverage, right? That part of the risk-reward trade-off that investors such as yourself and others are looking for is, how do I lever capital and how do I lever risk transfer solutions to make these investments in the first place? But what I find the biggest challenge is ultimately that most people, they would sooner take large losses in their supposed safe markets than to deploy a little bit of capital to get a first mover advantage in emerging and developing countries. And so what we try to do is, again, put solutions around that offers liquidity and helps hedge the worst things that can occur. So operating in your home environment, you can insure against country risk and political risk. But the second you become a cross-border investor, this is a risk you could fully transfer and put a liquid instrument behind.
Are you saying that since the fall and since Brexit, since the U.S. elections, are you noticing a change in demand for types of products for your business?
What I'm noticing right now is that chaos loves a vacuum as much as opportunistic investors, right? And I think a lot of people right now are looking at this retreat and the retrenchment that we see in many Western countries as an opportunity. The vacuum will be filled. The African continent will continue to emerge as a global powerhouse, and countries specifically in the African continent, I think, will spring forward, irrespective of whatever happens in the West and irrespective of our retrenchment and sort of return to economic nationalism. I think many countries and companies within those countries are becoming investment grade on their own, and new investors are coming in with a completely new yardstick. And they're not demanding things that follow our rubric of what is investment grade. They're creating their own. And I think that's an opportunity that others will just ignore, I think, to their own peril and to their own investor returns.
Well, thank you both for that. That's well, now we're going to add a little wrinkle to it. Because of the World Bank Group, addressing the challenge of fragility, conflict, and violence is a strategic priority, critical to achieving our twin goals and also promoting shared prosperity. So how does your answer to the first question, how does that change when we're talking about FCV states? Teresa, for example, for you, if you were to take an activist approach in an FCV state, what would that look like? And what are particular challenges that you would have to address?
Yeah. So just to reiterate that we invest in listed companies, and there aren't that many, and we're also in the emerging markets, not the frontier markets, although I have done a lot of work in the frontier markets. So there are some markets, for example, Cote d'Ivoire went through a terrible war. It does have a small stock exchange as listed companies, and they continued to trade during a difficult time, a time of conflict, basically. And I would say, in terms of our activism as being an activist investor in the emerging markets, we are really work closely with the majority shareholders of the companies to make the companies more valuable. So what's very key for us is that the controlling shareholders and the management of the companies are aligned with us in wanting to make their companies more valuable as listed companies, not making themselves richer outside of that listed company, which is another thing that people can do. And so we would look for exactly the same things in that fragile environment. Are the majority shareholders, which are often a family or a founder, and the management of the company aligned with us to make their company more valuable? I think it's a very well-known case study that CellTel, very successful telecommunications company that was developed in Africa during the 1990s, 2000s, very much in conflict states. I think they were in 12 countries, most of them in conflict. did extraordinarily well, partly because for both sides in the conflict, command and control systems were mobile phones. That's what they had. And they were darned if they were not going to pay their bill. And so they did a fantastic job in building a solid, well-run company, a regional company in multiple countries in Africa at a time of war. And in fact, they were benefited from it being at a time of war. But they also set in place very good corporate governance standards for themselves, a lot of transparency with their many investors, because it was a deal that many private equity investors were in, and many people made a lot of money off. And they were able to use that fragile environment to their benefit. But again, everybody was aligned. And they had great transparency with their investors. They had good systems and internal controls so that they could produce the financials that were required monthly by their investors, and worked very closely hand in hand with them. So it's going to be very much vary by situation. They happened to be in a sector where people would pay. And it's a little bit more difficult if you get into something that's very discretionary, and you're in a fragile environment.
So they had the right incentives because it was such an important sector.
The customers had the right incentives
Correct.
to pay, and the company just did things right. And bravo to them. It was I think a great example.
Great. Dante, I'm going to add a little bit of texture around the question for you. The regular risks that people are looking when they're investing in emerging markets are, for example, in an infrastructure project, the construction risk, the FX risks, perhaps the off-taker risk. So in an FCV state, those risks may become magnified. So what do you focus on more, perhaps in an FCV state, when you're looking at any kind of risk mitigation?
Yeah, so many of the things that are the kind of smoking crater variety risks that would cause an investor to lose money or a project to overrun and never see completion, those are the very types of issues that are readily insurable today in the private market. Things like war, terrorism, political violence, strikes, riots, civil commotion, and then there's this very long laundry list of a series of unfortunate events that are readily insurable. So we supported clients at the height of conflict in Iraq and Afghanistan, where there was literally sort of open war, open conflict. We've supported all range of private sector players in very, very kinetic, very dangerous environments. And then you have sort of that spectrum of fragility from Myanmar to post-conflict countries across sub-Saharan Africa. There's a lot of appetite. That's what this is one of the big ironies that I find, is I think there's a lot of appetite in the private sector, especially on the risk and insurance and the risk transfer side, to support these projects. The difficulty, and this is where I think there's an enormous opportunity for organizations like the World Bank Group, is to sort of really lever this more. The difficulty I find is to find the capital side. The investors aren't appreciating, I think, fully the opportunities of being able to really become first movers, right? That, it stands to reason and memory that the westward expansion in the United States was also an incredibly complex, risky proposition for the early industrial firms of this country. And that, frankly, the investment proposition of the British East India Company or the Portuguese equivalent was also a very risky proposition. But out of that risk comes the first mover advantage, right? Business is difficult everywhere. The failure rate of startups in the United States is still in the high 90s, as it is in Europe and elsewhere. And so I think the issue is that we have so many fears ingrained in our thinking about fragile states and emerging and developing markets that everything will go south, and that corruption, bribery, and fraud are endemic, and that you can't necessarily trade. And I think we need to expand the aperture, because most of the worst things that can occur, war, terrorism, and the lot, are readily insurable, including things like currency and convertibility. So dollars go in, but they can't come back out. Again, that's a readily insurable event. And where else can you get that much surety against black swans but in emerging and developing markets and in fragile states?
Can I voice a dissenting view? Sure. I was just in South Africa last week and talking to one company in a sector where their competitor had gone out to sub-Saharan Africa and set up supply chains for the sector. They were very important, and they said, we believe there's a second mover advantage, and because, well, why would you be the one to harass the government to create a road to get the tomatoes to sell in the store, et cetera? And so I think there is in fact often a second mover advantage, and people are a little bit afraid. And the other thing I want to bring up is the cost of that insurance. A lot of companies in South Africa that I spoke to last week had operations in Nigeria for obvious reasons. The biggest population country, and depending what measure you use, was until the Naira devaluation the biggest GDP country in sub-Saharan Africa, and so it's an obvious place to go. They got creamed on the devaluation, and since the country hasn't really floated the currency yet, they're still in the limbo on it, and it would be extraordinarily expensive to hedge that exposure for very long periods of time. And that, I think, is a real issue that we as emerging markets investors have on the currency hedging is it's not very expensive to hedge the currencies that are at fair value. And it's extremely expensive to hedge the currencies that are not at fair value. Right. And so it's easy to say, why don't you hedge it? But then you can eat up all your return through the hedge. Sure. So I just will throw out those couple things.
No, I think that's a very good point. I would add I agree with the second mover advantage. Yeah. At one point in my career, I used to manage Land Rover in 32 sub-Saharan African countries, and this is the very type of product that gets stuck in customs, that gets expropriated.
But not on the road. You get stuck in customs, but never on the road. You never get stuck yet.
Exactly.
Well, let's talk about just emerging markets in general, and it's probably magnified in FCV states. There seems to be, when we talk to institutional investors, a complaint about the lack of information. There's a lack of information about the project pipelines. There's a lack of information about what's really going on in the countries. What is really the rule of law? How assured can they be about the governance of companies? And in FCV states, one would argue that could be worse. Do you think the perception of risk, therefore, might be skewed for institutional investors just because there's a dearth of data? And is that one of the main issues for mobilizing private capital?
Yeah, I mean, no doubt. The risk perception and the risk reality, there's a huge gap there. And I spend a lot of time, most of my time, in fact, trying to address that and educate folks on that kind of trade-off. Having said that, the institutional investor, all they can do and all we can do is look at ourselves in the mirror and ask, are we imposing upon countries and investment opportunities an investment yardstick that they cannot abide by? And if that's the question, then don't even start pretending to go south of the Mediterranean and invest in many of these countries, because you will never be satisfied by imposing an investment yardstick on countries that can't abide by them. What you need to do in turn, and I think there's promising development in the impact investment universe, funds such as Leapfrog, groups such as MPIA, and others are really starting to normalize the process of investing in places that are perceptually riskier than they are in reality. And what these folks are doing is sort of like panning for gold, is they're finding that despite the macro environment and despite the opaque sort of working environments that you get in many countries, there are indeed diamonds to be found. And those diamonds really are individual firms. They're regional players that are starting to demonstrate that there's commonality across many markets. And companies like Celtel and others really articulate that. So I think the easiest thing to do if you want to change the world is to change yourself. And I think investors with a lot of capital need to look at themselves in the mirror and start there, and not impose questions upon countries and investments that they know the answers will go against their grain.
So Diane, I agree with Dante that if you have a view of investment that's different from the rest of the market, you have a differentiated view, that's when you can make money. And so I absolutely agree with that. The data point, though, is very interesting. When Macri took over in Argentina, what's the first thing he did? He said, our data is crap. We have been lying about inflation. So let's have a statistics office that we can really understand. That we can really believe. And so the first thing he did was change the numbers to reliable, consistent numbers that are objective and correct. And so I think this is actually a very important point, and that number of the reforms that we've seen in countries that are reforming do start with giving good data. And then when we take that down to the company level, and I think I made this point on CellTel, having good controls is very important for every company. But a lot of that reason for having the controls are manifold, but one is that you can produce data that your investors can believe. And that makes a huge difference in the price that a company can fetch. And whether it's in a fragile state or just a normal frontier market or a normal emerging market, or in the 1990s in the U.S. In the 1990s, the U.S. had bad reporting. Investors went in, invested in those companies, changed the reporting, got better reporting and then re-rated the stock, made a lot of money. By 2000, the game was over. You couldn't do it anymore because all the U.S. companies had good reporting. Well, in the emerging markets, the frontier markets, we're back in the 1960s. We can make more money by increasing the reliability of data and even the way it's presented, the accuracy with which it's presented. The same's true at the country level.
So directionally, then we only have one way to go, which is up. And that's part of the trade-off of accepting the business risk that you're investing at a level of development that is perhaps circa 1960, 1980, but that directionally there's only one way to go.
I would say
gravity.
Turkey might be an exception to that.
That is true. And we are spending a lot of time and effort at the World Bank Group figuring out ways in building databases so that there is a better availability of consistent data.
Yeah.
It's good data, but it's consistent because it's very hard to compare across countries for infrastructure projects. What's being done in South America may be very different than what we see being done in India. We really need to have that more consistent so that it can encourage, people can understand it, they understand what's the risk-return profile of these types of projects.
And the world relies on that data from the World Bank, from the IMF, and the OECD. It's extremely important, and BIS would be another source. Very important, and so this is why we hope the support for multilateral institutions continues, because it's critical. There's no one else looking over this data.
Correct. Well, one challenge for us on the bank side is to define what is a private sector investor, because if we look, for example, I'll use infrastructure as one of the sectors. Traditionally, these infrastructure investments have been put in the alternative investment category, which means it's not debt, it's not equity, it could be private equity, it could be private credit. Sometimes it's just one-off deals, but it doesn't fit anywhere. So what in reality, there are many types of investors. Are there different classes of investors that you would say are better suited for emerging markets or FCV states? Or when you talk to your peers in the market, can you really see a distinction between the types of investors that are attracted to different types of investments? Teresa? I'm sorry.
Go ahead.
Well, I mean, the answer is yes. So the question from the institutional investor point of view is, first of all, what is our time frame? So the pension funds and insurance companies tend to have very long time frames. And in fact, the pension funds and insurance companies invented the private equity structure, which is a 10-year commitment in order for the private equity manager to invest in companies and turn them around. And they get the full 10 years and sometimes even longer. And in infrastructure funds, we're now seeing 15-year infrastructure funds, and in some cases, evergreen infrastructure funds. So the very long time frame of the investment has to match the liabilities of that investor, that institutional investor. So the liabilities are very long. For university endowments, which is another big source of money, the issue for them is that they do have very long time horizons, but they also have to pay out generally something like 5 to 6% per year for the operating budget of the university, and universities depend on their returns from their endowment for between, making these numbers up, 2 and 40% of their operating, but depending on the straits that they're in. And I think the global financial crisis of 2008, 2009 really changed the calculus for a lot of these, and a lot of the university endowments became very much shy about taking liquidity risk. And this is what you're doing when you're tying your money up for infrastructure, taking huge liquidity risk. Further, the most enthusiastic investors in infrastructure have been the Canadian pension funds, whose governance structure is very different than the U.S. Funds. And it's a little bit, a little arcane, but if you liked it, we could go into that as to why right across the border you've got liability streams that are very similar and investing strategies that are very dissimilar because of the way they're governed. And then sovereign wealth funds, I would say, is another source of money, and it'll depend a little bit. Some of the Middle Eastern sovereign wealth funds are now finding themselves a little bit more constrained than they were, and so may be a little more interested in liquidity, less interested in taking the longer time frames, and that will vary from institution to institution.
And if I can, I think all of these types of asset holders labor under the same challenge, which is the diseconomies of scale. They're all so big, they have so much money under management that they're only looking for very big, very tangible things to invest in, which sort of has this insidious effect of crowding out other forms of capital. And then, no surprise, every single deal that we underwrite is an infrastructure project, an energy project, an extractive project. I mean, I think, ironically, corporate capital is becoming a more benign, if I could use the term, form of capital in many fragile states, because a lot of these companies effectively are prepared to own. There's no agency issue. They're not outsourcing to a fund or a fund manager the consequences of their capital. So a lot of corporations are starting to fill that void. And that void, I think, is the piece of the puzzle that is one of the root causes of a lot of the volatility. And road work doesn't hire people permanently. It just creates work. In the short haul, it might improve overall economic conditions in a country, as would an energy investment. But I think until we really find a way of getting capital in that middle market, and then further downstream, that sort of generates improvements in people's quality of life and addresses income inequality and all these root cause issues, more infrastructure and more energy investments in fragile states will not necessarily change the needle as fast as we need to change the story on their development.
Great. Well, I want to be able to get to some questions that have come from the audience. So I'm going to consolidate a few of the questions we have prepared and talk about just from a private sector, from a sector perspective. If we're looking at frontier, greenfield sectors where risks are deemed higher, we want to focus on climate. We want to focus on healthcare systems, for example. How can the risks in sectors which might, cross country boundaries, how do we address this in the various countries? And also, where do guarantees come in? Would guarantees, another form of insurance, would guarantees allow us to scale up the type of investments and the amount of investments we're able to do in these types of sectors?
Yeah. I think, the guarantee mechanism is one of the most underutilized mechanisms, especially when it comes to not crowding out capital. And I think that one of the big concerns people have is default risk. And, to leverage guarantees, for example, to support the ecosystem of entrepreneurial hubs that you're starting to see pop up all over the world. The hubs themselves could serve as sort of a proxy for what we have seen in the lessons of microfinance, that where there is this kind of corporate sort of environment, people are less likely to default. And perhaps a guarantee mechanism could support that. I mean, the main thing is, for those of us in the risk business, we cannot aspire to remove every risk from every investment or transaction.
Because then you
number one,
earn the risk-free rate.
Right. Well, number one, then what fun is there in that? And number two, you get rid of the animal spirits that is supposed to drive these ventures in the first place. But I think there are very promising opportunities in sectors across the world, and especially in many fragile states. I think logistics is one in which you could argue to overcome the lack of infrastructure and to overcome the lack of paved roadworks, logistics firms and the potential to Uberize, if you will, getting goods, whether they're business goods or if it's just movement of people. I think that's an enormous opportunity across the world, and the advent of the technology and the adoption of these mobile phones, which are ubiquitous in so many of these countries, really has the enabling fabric for these types of business models. And the good news is the product that you would invest in doesn't get stuck in customs, right? So the friction of having to trade with many fragile economies more or less goes away, but it's not one of those big tangible investments that you have to cut ribbons to inaugurate a new power plant. But I think those types of opportunities are native all over the world, and they should attract much more capital than they tend to.
The mobile technology is making a huge difference, particularly in Africa. There are many examples in Kenya for people getting access to energy, and it's all with the phone. So that's been a huge help across the countries we're dealing with. Okay, we're going to move into some of the questions that we received from the audience. The first question is, how do we manage the risk and growth of an investment or project in a fragile area like we have in the Niger Delta region of Nigeria to keep investors coming as well as to retain their investments? So we're thinking of a risk that a project does not pay off as promised, so investors don't come back or try to exit.
Well, the Niger Delta recently has been almost a civil war situation and somewhat held hostage the whole country. And so I would say that is very much a macro political issue and really has to be dealt with by the federal government of Nigeria. It's no company, and again, I totally agree with Dante, there's going to be companies there. No company is going to risk their staff in that sort of situation, much less the theft of their product, right? I mean, so a lot of oil is being stolen. And perhaps it has exacerbated the macroeconomic issues at a time when oil prices were coming down and the government was losing control of the macroeconomic environment and the value of the naira. So it's almost a perfect storm issue. For me, it'll all come back to what the federal government does.
Yeah. Well, and I think the case of the Niger Delta is illustrative of what I was describing earlier, which is that when you only invest in extractive industries, and if those are the only industries that get capital, that get insurance support, that buy political risk insurance, the lessons learned in many of these countries is that many of these investments aren't necessarily translating into broader development in the people in the region and the society, and that wealth dislocation is part of what is driving the instability in the region. There are solutions against these types of issues, but it won't address the root causes of instability, and it certainly won't do much to satisfy the billions to trillions gap toward achieving the SDGs.
The question is, were any of those projects insured by OPIC equivalents or MIGA, and did they pay out as political risk? One issue I have had just conceptually with MIGA is they've prided themselves on never paying out a cent on a political risk they've insured. And so how can that be a success measure? To me, that is not a success measure. They won't be successful till they have paid out. They're not taking enough risk unless they have paid out something, right? To have never paid out a claim, why would anyone take their insurance? And we have this famous case in Forbes magazine, I think, in Russia, where their offices were raided by by security guards, right? Well, it turned out that some of those were off-duty police. Because they were off-duty police, they could then say it went back to the state and there was political risk and they got paid off by OPIC. But only because having your office ransacked by a competitor and destroyed, basically, and being threatened with death by a competitor, that wasn't insurable. But if the government were involved, that was only because they had these off-duty policemen. So I think there's some imperfections in the market for political risk insurance, and Dante knows a lot more about it than I do.
With respect to MIGA, quite often just being part of the World Bank Group has been an incentive that benefits MIGA because there's a lack of willingness or less willingness to default on something. So I
okay, so they could have an advantage right there. I take that. Good
That's
point.
the other.
Well, it's the political risk equivalent of speak softly and carry a big stick.
Yes.
Right.
Soft power. Yeah.
But I think the issue for why this market has the very distortion that you observed, especially when you think about the multilateral providers of these solutions, the distortion stems from what is known as adverse selection. That the only risks that ever make it to the market are the ones in the worst places on the planet. And so no surprise, it is harder to price, harder to underwrite, and we only underwrite the very biggest things. And so what I've been advocating for is to create a better, broader platform that spreads the risk, and so that it's not just the worst things that make it to the market, but it's really, frankly, a spread of them. And that will drive down pricing, increase availability. And we really want this to be an investment promotion mechanism as opposed to something that's prohibitive.
Sounds a little bit like the Affordable Care Act. A little bit.
It does. A bigger pool.
Speaking of political risk.
A bigger pool of risks. That's right.
Another question from the audience is that there are many private investments in the Mekong, and there have been many environmental and social disasters related to these developments. Some, according to this question, were not the fault of the investor, but perhaps poor planning of the operations. So how can investors interested in social impact investing mitigate against these types of disasters, which are from unexpected consequences?
Yeah. So I think this is an emblem of this concept that in the era of man-made risk and in the era of hyper-transparency, there's no such thing as being a long-armed investor any longer. One example of this is the collapse of the Rana Plaza building in Bangladesh. That in the risk business we have something known as a vicarious liability. That is when your neighbor's dog or your dog bites the neighbor's kid. It's ultimately your problem if it's your supply chain. And I think these types of issues, no matter what the cause, corporations, investors, leaders need to manage and own the consequences. You can't wash your hands of your exploits half a world away. And so in the Rana Plaza collapse, you saw that the global garment industry instantaneously had to come out with adopting a code of conduct and standards and what have you. That wouldn't have happened 30 years ago. And I think these become normalizing factors, that whether it's in the Mekong Delta or in the Niger Delta, eventually, in the era of hypertransparency, the concept of a long-arm, remote investor with zero liability, I think that's a rarity these days. And that's part of the reason I think many folks are just leery to invest in the first place, because they know that today, unlike at any point in human history, all of these misdeeds abroad will come back to haunt you. But that shouldn't be an argument for not investing. If anything, it's an argument for investing and actually abiding by the concept of a triple bottom line, where you balance economic, social, and environmental impacts. But all too often, we're not doing that.
I'm a little unclear on the question because if I were investing in a company, as we have companies that have operations in Vietnam, we want to make sure that those companies have looked at the environmental risks of what they are doing, that they've mainstreamed that into their own processes and procedures, that they understand the social risks they are possibly creating or working alongside or in their environment, and again have incorporated that into their processes. We look at those as both risks that we have to look at and opportunities if we believe there are things that they can do better. And therefore become a more valuable company because they're doing things right. And so those are, I don't understand in the question whether who was at fault, because if these are foreseeable and they're risks rather than uncertainties, someone should have been able to look at the various risk scenarios for those and put in place safeguards.
It sounded, my interpretation was it was a little bit about, was the project preparation adequate to
Due diligence,
foresee any of these catastrophes? Correct.
Yeah.
Well, remember, I think one very, very important admonishment is that you can't decouple the fortunes of companies from countries, right? That when the U.S. is misbehaving, corporate America, McDonald's and the Golden Arches become liable, right? And so oftentimes companies and
We're
investors...
seeing that in Mexico right now, sadly.
You know, investors inherit the misdeeds or the market perceptions of their countries. Embargoes and trade, tit for tat. I mean, I think we're going to sadly enter a period of a bit of tit for tat political risk and point scoring at the national level, especially with the specter of deglobalization and sort of decoupling. But notwithstanding all of that, I think that corporations and investors really have an opportunity here. That in that vacuum, you don't have to fend with competition. And in many of these markets, I mean, you stand to shape the entire outcome of the day. And to do so, balancing these other priorities only proves to be a better investment in the long run.
And then just a technical point. A lot of investors see the environmental and social as a bolt-on. They don't see it as an integral part of their due diligence and assessment of a company and whether that is investable. But for us, it's, for example, very important that environmental, social, and governance analysis is done by the analyst who is presenting the investment case to the investment committee, not by a separate group, over a wall somewhere that's bolted on and, listened to just out of politeness. No, it is actually a key part for either an investor or a company that's making that investment. And that mindset has to change.
I think we have time for one more question, so I'm going to take this question and add to it because I'd love to hear your views on the role of the World Bank and other multilateral development banks and how we can better enhance the environment for investment. For example, when you're structuring risk management to encourage investors in FCV states as well as in emerging markets in general, is there a method for buying down risks for a country or government in a conflict or fragile state? And then another way of asking that is the World Bank wants to partner more with the private sector. What would you like to see more of from the World Bank, IFC, MEGA, to help promote more partnership with the private sector and really encourage the mobilization of private capital? So we're doing some now, but what else would you, from your perspective, think would be very valuable?
So that's a great question. I think step one is to acknowledge all of the sources of capital that contribute towards countries. And, remittances account for an enormous peer-to-peer cash transfer, $608 billion in 2015, totally recession-proof, totally peer-to-peer. And with the advent, again, of this return to economic nationalism, it's a cash flow that I think the World Bank has a unique obligation to defend, promote, and ensure that any type of retrenchment of nationalism doesn't obstruct that and driving friction. And I think there are also insurance solutions that can protect the interruption of that cash flow. That goes into the hands of real people, and it contributes towards their development and purchasing power. Official development assistance, sadly, has flatlined over the last decade. And so, if that is going to be the operating reality, I think the onus for the World Bank and multilaterals like the World Bank is to become more efficient and effectively become a source of leverage, whether it's through putting together events like this or the Development Finance Forum, but bringing private capital to bear, and then creating hybrid structures that address the billions to trillion gap, both on the risk and the capital side. I think it's a unique obligation of the World Bank to do more with less. And it's not just the World Bank that faces that operating reality. I think most advanced economies are constraining their development assistance, and so we all need to lever up much more strategically. And then finally, this concept of foreign direct investment and how to promote it and protect it. there are solutions out there. And I think one of the ways we make those solutions more strategic and accessible is to break the pattern of adverse selection, which is that only the worst countries with only the highest risks seek the solution. And so ways to do that would incorporate, again, that the World Bank is uniquely poised. I've always dreamt of the concept of a country sponsoring a political risk solution to promote inward investment in the country. So I think there's a lot of opportunities to build that hybrid approach, become more efficient. But I think that's and then last but not least, I think there's a huge burden on the global asset manager to invest in the very world and in the very stability that they thrive on. Short of doing that, all of these issues are coming home to roost. The migration crisis in continental Europe that shattered the Schengen Agreement, that is breaching NATO's sort of capability to respond, all of that is a function of underinvestment. And eventually, these things are coming home to roost. And so we need to become more activists and thoughtful about what types of risk-reward trade-offs we're willing to accept, and over a slightly longer horizon than we're used to.
Teresa?
Well, from my point of view, from the World Bank specifically, we would really value the reform agenda. That the countries that are investable are those that are reforming and becoming less risky. And we measure that by taking their CDS spread down. And it's through political and economic and institutional reforms that they can do that the World Bank is uniquely placed to do. Part of that also would be infrastructure, which the World Bank has a role in terms of the approaches to infrastructure and getting corruption out of the PPP process, out of the concessioning process, that the World Bank can do that. The IFC can do the funding part, but the World Bank can do the regulatory part of that. Data we already talked about. And the other very important thing is the doing business agenda, getting rid of red tape, having a min-max solution to your bureaucratic regulations. So we want to be in a regulated free market environment, but we want good regulations and get rid of some of the disenabling regulations. And then the IFC side, really I think being faster at processing projects, less bureaucracy. Companies that I deal with that deal with the IFC find the bureaucracy bewildering and time-consuming, and that just, that's human. That can be changed. I'd also like to see them be more courageous. We fought against a shareholder that was stealing money from minority shareholders and would have loved to see the IFC step up as well. We believe that we need to have the courage of our convictions. If someone's doing something wrong, we will say so. We'll try to say that privately. If it becomes public, what can you do? But it is really important to hold to task people who are treating minority shareholders badly and who are manipulating regulatory environments for their own benefit. And so we would like to see more courage as well.
Well, I want to thank both of you. I think this has been an incredible panel, great discussion, very honest opinions, and really,
sorry about that.
No, that's fine. But moving forward, I think there's an agreement that there is a need for great data, good, consistent data across the globe in order for investment to occur more readily. Also, the risk-return profile must be addressed, but it's not necessarily that the return isn't adequate, but we really have to get more understanding about this is the risk and this is the commensurate return, because sometimes people think emerging markets, I need 12, 15, 18%. And as you said, the differential spread between developing economies and emerging economies could easily shrink because we have more uncertainty in the U.S. and in Europe. And also, I liked what you said about alignment of incentives. It's the government and the companies, but it's also the companies, the investors. As long as everyone is on the same page and they understand where they're coming from, what the risks are, that's going to help mobilize more capital. And just to reassure you that the World Bank agenda and IFC and MEGA, it is on very much the reform side, because we understand that creating the enabling environment is critical to getting private sector investment. And not all economies right now might be ready for private sector investment, but it's really, it's baby steps. It's one step at a time, and the enabling environment, better regulatory system, better governance is critical. So thank you, everyone, and we hope you enjoyed this session and have a wonderful rest of the day, afternoon, and evening. Thank you.